Good morning to my lecturer and my fellow classmate. My name is GHEENANDHINI and I'm from SUKUMAR and my metric number is 282892. We are from group 1 and we are going to present on chapter 6, which is about risk and return. So this slide will be looking into the concept and skills. Alright, basically in this chapter, what are the concept and skills that we will be learning is, number 1, how to calculate expected returns, variance and standard deviation. Number 2, the impact of diversification. Number 3, the systematic risk principle. And lastly, the security market line and the risk return trade-off. Next, we'll be looking into the expected returns slide. So what are the expected returns? So expected returns meaning are the based on the probability of possible outcome. Number 2, in this context, expected means average if the process is repeated many times. Lastly, the expected returns does not even have to be a possible return. So if you see on my cursor, I'll be showing into it in a box, which is this are the formula for the expected returns. So these are the formula we'll be applying for the next slide on the sample questions. So the next slide is example of expected return. So in this example question, they have mentioned that suppose you have predicted the following returns for the stock C and T in 3 possible states of the economy. What are the expected returns? So here we have 3 states and we have probability and we also have for stock C and T. So basically we don't have the figure for recessions. So how do we get this? So in general, the expected return on a security or other asset is equal to the sum of the possible returns multiplied by their probabilities. So if we had 100 possible returns, we will multiply each one by its probability and sum of the result. So basically what we have to do is we will take 1 minus 0.3 minus 0.5 and you will get 0.2 over here under the recessions. So for we have to count on the stock C and T here. So how do we count? So since we have the probability figure, so we can multiply with stock C and T. So first we'll be looking into stock C first. Alright, so first we have to proceed with the probability, which is 0.3. You multiply with 0.15 and then you add with 0.5, which is multiply with 0.10, and same goes to here also. We will take 0.2 over here and multiply with 0.2. So that's how you will get for stock C, which is 9.9%. The same formula that you will be applying on the stock T also. So you take 0.3, multiply with 0.25, add with 0.5, multiply with 0.20, and add with 0.2, multiply with 0.01. So you will get about 17.7%. So this is how you will be counting for the probability for the recessions. So next, we'll be looking into the variance and standard deviation. What is variance and standard deviation? Variance and standard deviation are the measure the volatility of return. So the higher the variance, the higher the risk. Using unequal probabilities for the entire range of possible with average of squared deviation. So these are the formula on variance and standard deviation. So we'll be applying on the next slide on the sample questions. Alright, so these are the example variance and standard deviation questions. So consider the previous example. So meaning I will just click on the previous slide. So this is the same figure, the same question similar to that. Alright, we'll be applying the same figure over here. Alright, so here you see on the standard deviation. Alright, so on the finding of variance for stock C, the same figure and the same recession where we have found is 0.2. So how do we do it for this formula? So for count the variance, we'll be taking the probability 0.3 and then we'll be taking the figure of stock C 0.15 and the minus with 0.099. So how do you get 0.099? So meaning in your previous slide, you have 9.9%. So you have to divide with 100, you will get the 0.099 and you square root it. So basically this is how you have to do. I repeat again. So you take 0.3 over here and then you put bracket 0.15 minus with 0.099 bracket close and square root it. So that's how you apply for the figure 2. So plus again, take 0.5 and then bracket, open bracket 0.10 minus with 0.099 bracket cross square root and then add with 0.2 and then open bracket again 0.02 and minus with 0.099 close bracket with square root, and you get basically is 0.002029, and the standard deviation you square root it back and then you will get the figure, and then you can convert into percentage, which is 4.50. all right. So basically over here the same application that we're going to apply in stock C2. So we have to count the variance. So the variance is 0.3 open bracket 0.25 minus 0.177 close bracket square root 2, and you add on with 0.5 and then open bracket with 0.20 minus with 0.177 close bracket and square root it, and you add again with 0.2 open bracket 0.01 minus with 0.177 close bracket square root, you get about 0.007441. So basically for the standard deviation, once you square root it and you'll get about 8.63%. So how do you get? Once you square root, you have to times with 100% and you will get about 8.63%. So this is how you have to count for your standard deviation and variance as well. All right. So the next slide will be on portfolio. Okay, so what is portfolio? Portfolio is a collection of assets. An asset risk and return are important in how they affect the risk and return of the portfolio. The risk return trade-off for the portfolio is measured by the portfolio expected return and standard deviation, just as with individual asset. All right, so here you will see on the example of portfolio weight. So here basically the new question is, suppose you have 15,000 to invest and you have the purchase securities in the following amounts. What are the portfolio weights in each security? So here we have indicate each short words into their actual name. So C is for Citigroup, KO is for Coca-Cola, INTC is for Intel, and BP is for BP. All right. So these are the amount for the each groups, basically you can see, or each security. All right. So 2000 is for Citigroup, 3000 is for Coca-Cola, 4000 is for INTC, and 6000 is for BP. All right. So how do you get it? All right. Okay. So you have to take the 2000 divide by the invested money, 15,000, and you will get about 0.133. So same has been applied to KO. So 3000 you divide with 15,000, you get 0.2. INTC also same. Take 4,000 divided by 15,000, you get about 0.267. And lastly for BP, take 6,000 divided by 15,000, you get about 0.4. All right, so basically on portfolio expected returns. The expected returns of a portfolio is weighted average of the expected returns of the respective asset in the portfolio. Like I said, this is the formula that we're going to apply on the portfolio expected returns. You can also find the expected return by finding the portfolio return in each possible state and computing the expected value as we did with individual security. And I will end my part over here, and the next part will be continue with my another group mate will be presenting for the upcoming slide. Thank you.
Hi, hi, and Assalamualaikum to Madam and also my classmates. My name is NURASHEEFA SHARENA binti ZULKIFLI. My metric number is 280866. Okay, so now we are gonna look to example of expected portfolio returns. Okay, consider the portfolio weights computed previously, which is you have learned how to calculate the portfolio weights. Okay, this for Coca-Cola is 0.1 For Citigroup is 0.133, for Coca-Cola 0.2, right? And others. Okay. So if the individual stocks have the following expected returns, what is the expected return for the portfolio? So we gonna take the portfolio weights and we multiply it by the expected return of each security. Okay, so for this one, we're going to take 0.133 multiplied by 19.69% plus 0.2 multiplied by 5.25% plus 0.267 times 16.65% plus 0.4 times 18.24%. Then we will get the answer is 15.41%. We need to remember that to compute the expected portfolio return, to compute the portfolio variance and also standard deviation, we are using the same formulas as for an individual asset. Okay, so to make it more clear, let's take a look at another example of portfolio variance. Consider the following information on returns and probabilities. Okay, in this example, we are given two different states, which is in boom period and also bust period, and we invest in two different stock, which is in asset A and also asset B. Okay, so first question is what are the expected return and standard deviations for each asset? So to calculate the expected return for asset A, we are gonna to multiply the probability of each state by its return for the each state lah in the asset. Okay, for asset A, we're gonna take 0.4 times 30 plus 0.6 times negative 10 and we will get 6%. And for the variance, we use the same formula as for an individual asset. Okay, 0.4 multiplied by 30 minus 6 power by 2 plus 0.6 multiplied by negative 10 minus 6 power by 2 and we will get 384. So we square the answer and we will get 19.6% for the standard deviation. So same goes for asset B. We will take 0.4 multiply by 5%, negative 5, plus 0.6 multiply by 25, and we will get 13%. And for the variance, 0.4 times negative 5 minus 13 power by 2 plus 0.6 multiply 25 minus 13 power by 2 and we will get 216. Then we square 216. So we will get the standard deviation is 14.7%. Okay, for the next question is what are the expected return and standard deviation for the portfolio? So this one we are going to calculate it. First of all, we need to find the portfolio return in each state. Okay, in boom and then in bust. Okay, for in boom period. Okay, before that, it have state that we invest 50% in asset A. So for asset B, we also invest 50%. Okay, to calculate it, 0.5, we need to times 30 and 0.5 multiplied by negative 5. So we will get 12.5. And for the portfolio return in bus, we will take 0.5 multiplied by negative 10 plus 0.5 multiplied by 25 and we will get 7.5. So to calculate the expected return, we will multiply the probabilities with each return of each state. Okay. For this one, we will take 0.4 multiplied by 12.5 plus 0.6 multiplied by 7.5 and we will get 9.5. And for the variance, 0.4 times 12.5 minus 9.5 power by 2 plus 0.6 times 7.5 minus 9.5 power by 2, and we will get 6. And for the standard deviation, we will square 6 and we will get 2.45%. So that's how we going to calculate expected return of individual asset and also expected return of the portfolio. Okay, there are different types of return, which is expected return and also unexpected returns. Expected return of an asset is what an asset should earn based on what people know. Okay, it is like something that we can predict. Okay, it's like predictable lah. Okay, however, sometimes we need to realize returns are generally not equal to expected return. Okay, which mean it sometimes it can be unexpected returns. Okay, uh, during the unexpected return, it can be either positive or negative result lah, uh, of the return on the stock. Okay, next one is announcement and news. Announcement and news contain both an expected component and also a surprise component. It is the surprise component that affects a stock price. Therefore, it's also affect its return. Okay. Contohnya macam contoh, the company is going to make an announcement about the profits, okay, about the profits of the company. So it should not be surprise anyone, since the information is easy to figure out based on the sales figure that are available online. Okay, so that's why it can be expected returns. That's why the announcement can be expected return lah. But for the unexpected return, for the example, maybe the company is going to change the dividend structure. Okay, so that the quarter dividend is a lot higher or lower than investor are expected. So then this could have a positive or negative effect on the return of the stock. Okay, this is because it is surprise component. Okay, so we can't predict it. It is not predictable lah. Okay, and next one is efficient markets. Efficient markets are a result of investor trading on the unexpected portion of announcement. The easier it is to trade on surprise, the more efficient market should be. Efficient markets involve random price changes because we cannot predict surprise. Okay, just now we have learned about expected return and also unexpected returns. This one we will learn about systematic risk and also unsystematic risk. Systematic risk is a factors that affect many assets, or we can say it is associated with market factors that affect all industries, that affect all firms. It is also known as non-diversifiable risk or market risk because it is cannot eliminated by diversification. Contohnya macam changes in GDP, inflation, interest rates, war or COVID-19. Okay. Next one is unsystematic risk. Unsystematic risk is risk factors that affect a limited number of assets. Okay, we can say it is the risk that unique to a specific company or specific industry only. It is also known as a unique risk lah, and as a specific risk. And the nature of this unsystematic risk is can be eliminated by the diversification. Ianya boleh dihapuskan dengan diversification. Okey, contohnya macam labor strikes, part shortage, lawsuit and others lah. Okay, next one is return. So formula untuk total return is expected return plus unexpected return, and unexpected return consists from systematic portion and also unsystematic portion. Therefore, kita boleh express total return as follows, which is expected return plus systematic portion plus unsystematic portion. And the next one is diversification. So what is diversification? Okay. Portfolio diversification is the investment in several different asset classes or sectors. It is not just holding a lot of assets, but it's hold a lot kind of assets. For example, if you own 50 internet stocks, you are not diversified. Maksudnya, you buat satu investment, macam you invest 50 internet stock tu, maknanya you invest dalam satu industri sahaja. So kalau ada apa terjadi, means if there is anything bad happen to the investment, and you are going to lose everything that you have got. Okay, however, if you own 50 stock that span 20 different industries, then you are diversified. Okay, contohnya macam yang ni, you own 50 stock, macam you hold 50 stock yang you invest dalam macam-macam industri. Maksudnya macam dalam industri teknologi, then you invest dalam industri education, industri agriculture, industri airline, industri retail, kan. So if contohnya if there is something bad happen dekat you punya industri teknologi, you punya investment dalam industri teknologi, so you still ada lagi you still lagi boleh dapat pulangan, you boleh dapat lagi return dalam dengan you punya investment dalam industri yang lain. So you tak letak satu risiko tu dalam satu tempat sahaja. Okay, so macam jadi bila you lebih selamat lah bila you bagikan risiko. So if anything happen dekat satu industri ni, you still boleh cover the return from others industry. Okay, so that's all from me.
A very good day to Doctor and my dear friends. I'm Kavines Nair ANANTHAN and my metric number is 282906. Okay, let's see about the principle of diversification. Okay, diversification can substantially reduce the variability of returns without an equivalent reduction in expected return. Okay, first of all, apa itu diversification? Diversification bermaksud kepelbagaian. Yang pelbagai, diversity, kepelbagaian. So, dalam statement pertama, kita boleh tengok bahawa kepelbagaian boleh mengurangkan kebolehupayaan pulangan dengan ketara tanpa pengurangan yang setara dalam jangkaan pulangan. Okay, this reduction in risk arises because worse than expected return from one asset are offset by better than expected return from another. Okay, pengurangan risiko ini timbul kerana pulangan yang lebih buruk daripada jangkaan daripada satu aset diimbangi oleh pulangan yang lebih baik daripada jangkaan daripada yang lain. Okay, however, there is a minimal level of risk that cannot be diversified away that in the systematic portion. So, walau bagaimanapun, terdapat tahap risiko minimum yang tidak boleh dipelbagaikan. So, ada satu tahap yang tidak boleh dipelbagaikan dan itu adalah bahagian yang sistematik. Okay. Okay, figure 13.1 kita boleh tengok diversifiable risk. Ini lengkungan diversifiable risk, and then ini pula the distance of non-diversifiable risk, and this is a average annual standard deviation graph. So there will be an x axis, and then the y axis you can see number of stocks in portfolio. So this will be the graph of the standard deviation. Okay, diversifiable risk, kepelbagaian risiko. So the risk that can be eliminated by combining assets into a portfolio. Risiko ini boleh di-eliminate, boleh eliminatekan ataupun dimansuhkan by combining asset into a portfolio. So lepas tu often considered the same as unsystematic, unique or asset specific risk. Okay, then if we hold only one asset or assets in the same industry, then we are exposing ourselves to risk that we could diversify away. Ini merupakan ciri-ciri diversifiable risk. Sekarang kita tengok total risk pula. Dalam total risk, the formula of total risk is systematic risk tambah unsystematic risk. Okay, so untuk dapatkan total risk, kita kena tambahkan systematic risk and unsystematic risk. So automatically kita sudah tahu kita ada dua risk. Satu ialah systematic, satu ialah unsystematic. So kalau tambah dua-dua, kita dapatkan risiko yang penuh macam tu. So the standard deviation of return is a measure of total risk. So standard deviation merupakan return of measure of total risk. And then for well diversified portfolios, unsystematic risk is very small. Okay. Consequently, the total risk for a diversified kepelbagaian portfolio is essentially equivalent to the systematic risk. Systematic risk principle. Principle systematic risk. Tadi kita nampak systematic risk dan unsystematic risk kan. Ini untuk systematic risk pula. Bagi systematic risk, there is a reward for bearing risk. Seterusnya, there is not a reward for bearing risk unnecessarily. Bearing risk ada, tapi not for unnecessary things. Macam tu. So the expected return on a risky asset depend only on the asset systematic risk, since unsystematic risk can be diversified away. Unsystematic risk itu kita boleh diversify, kita boleh eliminate like that. Okay, sekarang kita dalam slide yang sangat penting ya. Okay, slide ini kita boleh tengok how to measure the systematic risk. So, as saya ulang balik, kita ada dua risk. Satu itu systematic risk, kedua itu unsystematic risk. Unsystematic risk tadi kita boleh diversify away kan. So, okay. Now let's see how to measure the systematic risk. So, how do we measure? We use beta coefficient. Yes. Then what does the beta tell us? Okay, kita guna beta coefficient. And then beta coefficient tell us apa? This is the main thing. Okay, a beta of 1 implies the asset as the same systematic risk as to the overall market. Macam tu. So kalau dapat satu, kalau sudah kira and then dapat satu, that mean the systematic risk is overall market, same of overall market. Okay, kalau dapat kurang daripada satu, less than 1, what it considered? If you get less than 1, then the asset has less systematic risk than the overall market. Okay, kalau kurang daripada satu, ia merupakan kurang systematic risk daripada keseluruhan market tersebut. Okay, kalau lebih daripada satu, if more than one, what it means? If more than one, it means the asset have more systematic risk than overall market. So maksudnya kalau lebih daripada satu, ia merupakan mempunyai aset yang lebih systematic risk than overall market. So untuk pelajar-pelajar easy to remind, if less systematic risk of overall market. If more systematic risk of overall market. Kalau satu tak ada lebih, tak ada kurang, hanya satu same systematic risk of overall market. Okay, saya harap semua faham. Let's go to the next slide. Okay, dalam slide ini kita boleh tengok selected betas of some companies lah. Contohnya Johnson Johnson, Coca-Cola, Twitter, Pfizer, Tesla, Ford, Apple and SUBAS Corporation kan. So ini merupakan beta coefficient bagi company-company tersebut. So this is an example to you guys to see the beta coefficient of those companies. Okay, let's go to the next slide. Okay dear friends, ini merupakan slide yang sangat penting juga. Okay, dalam slide ini we have some calculation ataupun cara yang kita learn sebelum ini. Okay, so let's see ya. Okay, first total vs systematic risk. Okay, dalam ni kita boleh tengok there are two security C, security K. The standard deviation of security C is 20%. And then the beta of security C is 1.25. Security K 30%. And then beta of security K is 0.95. Tadi kita nampak kan beta ada tiga jenis. Satu less than 1, more than 1. Kalau satu is same to the overall market. Less means less in the overall market. More means more systematic risk in the overall market. Macam tu. So automatically direct to the second question lah. Which security has more systematic risk? Kalau more than 1, so security C. Security C has a higher systematic risk. Okay, kita balik kepada soalan satu pula. So, which security has more total risk? Total risk, there are two ways. The formula of total risk apa? Systematic risk tambah dengan unsystematic risk. Okay, systematic risk kita sudah tahu. That is 1.25. Unsystematic risk is the percentage. So when you calculate both together, the K is the more higher. So this is the way you have to find out which is have the more total risk. So sebelum itu you kena tahu apa formula tersebut. You kena ingat. Okay, total risk. Okay, dia punya formula apa? Systematic risk tambah unsystematic risk. Okay, systematic risk punya formula apa? Formula ataupun cara pengetahuan apa? So there is a three way. One is same, one is more than 1, one is less than 1. So macam tu, ingatkan. So it will be easy for you. Then which security should have the higher expected return? Okay, this is a very good question. Security C has a greater expected return as systematic risk is higher. Based on the systematic risk principle, the expected return on a risky asset depends only with the systematic risk. Okay, this is a very important slide. Okay, let's see how to calculate the portfolio's betas. Consider the previous example with the following four security, right? Okay, the C, KO, INTC and BP security have weight and beta. So how to calculate the portfolio beta? It's very easy. We need to multiply the weight with the beta. So 0.133 multiply with 1.685, what do you get? So use your scientific calculator, you should get 0.224. Then 0.2 multiply with 0.195, 0.039. 0.267 multiply with 1.167. You should get 0.3099. 0.4 multiply with 1.434. You should get 0.574. So, selepas mendarab semua itu, tambahkan semua beta-beta tersebut. So, after you add everything, you should get 1.147. So that will be your portfolio beta. Alright, so next slide. Okay, beta and the risk premium. So everyone should remember that the risk premium ialah expected return tolak risk-free rate. So this is a new formula. Take note, risk premium is equal to expected return yang jangka pulangan tolak dengan risk-free rate. Okay, so the next is the higher the beta. Semakin meninggi beta, semakin tingginya risk premium should be. Okay, this is the beta and the risk premium relationship lah. Alright, you can see the example of portfolio expected return and betas. So in the x-axis you can see the expected return, and then the y-axis you can see the beta. So you can see the line graph is increasing. So as we know, when the expected return is increased, the beta also will be higher. So it should be like that. So I hope you guys clear, and if you have any questions, don't hesitate to PM in the group and then ask our doctor also. Okay, I pass to the next presenter. Thank you, everyone.
The following slide is reward to risk ratio, the definition and example. The reward to risk ratio is the slope of the line illustrated in the previous slide. Here the slope is equal to expected return rate minus with risk-free rate divided with beta minus 0. So the answer for the answer of the reward to risk ratio for the previous slide is 7.5. Okay, what if an asset has a reward to risk ratio of 8? If the reward to risk ratio is equal to 8, then investor will want to buy the asset. This will drive the price up to the expected return down. What if an asset has a reward to risk ratio of 7? If the reward to risk ratio is equal to 7, then the investor will want to sell the asset. This will drive the price down and the expected return up. The following slide is market equilibrium. In market equilibrium, all the portfolio means the collection of assets. An asset should have reward to risk ratio and they all should be equal. For my understanding, market equilibrium is supply of goods matches the demand. Below is the formula for a market equilibrium. Expected return rate minus risk-free rate divided with beta is equal to expected return minus with expected free risk rate divided with beta in the stock. Okay. This is the security market line. The slope of the security market line is the reward to risk ratio. The reward to risk ratio is the expected return subtracting risk-free rate and divided by the beta of the stock. But since the beta for the market is always equal to 1, the slope can be rewritten. The capital asset pricing model, also known as CAPM. It defines the relationship between risk and return, and also it determines the expected returns on the capital investment. If we know an asset systematic risk, we can use the capital asset pricing model to determine its expected return. If we know an asset systematic risk, we can use the capital asset pricing model to determine its required return. We use beta to measure the systematic risk. What are the factors affecting expected return? First is pure time value of money, which is measured by the risk-free rate. Second, reward for bearing systematic risk, which is measured by the market risk premium. Third is amount of systematic risk, which is measured by the beta. So this is one of the example of capital asset pricing model to calculate the expected return. In the previous slide, we have the formula, which is expected return is equal to risk-free rate plus beta, open bracket, expected return minus the risk-free rate. Okay. In this question, consider the beta for each of the assets given earlier. If the risk-free rate is 4.15% and the market risk premium is 7.5%, what is the expected return for each? Okay. For example, we took the security C. The formula, okay, first for risk-free rate, which is 4.15 plus with the beta 2685. 2.685. Okay. And then multiply, which is open bracket, 7.5 close bracket. 7.5 bracket, which is the market risk premium. Okay. How do we calculate the market risk premium? Is subtracting expected return minus with risk-free rate. Okay. When you calculate it, you will get 24.2875. Okay. And then when you convert it to 2 decimal point, the answer will be 24.29%. So the following are the same method to calculate. You can calculate directly to get the answer. Okay. The following slide, okay, this the slide is the figure of the security market line along with the equation describing the security market line. That's all from us. Thank you, Doctor.